Thereafter, in the end, we will devote certain time to discuss some of the issues and some of the amendments which have been brought out of 48 GST Council meeting. So let's start with the interpretational issues. The first issue is recovery of ineligible transitional credit along with interest. Friends, we are aware that many of the taxpayers had filed trans 1 form and claimed transitional credit. A good amount of scrutiny has undertaken place all over India. So what department is doing these days? They are scrutinizing the trans 1 form, and if they feel that the credit is ineligible, they are issuing show cause notice demanding the transitional credit. So various taxpayers are getting and receiving show cause notices for recovery of transitional credit along with interest and penalty. The issue which we want to discuss is that whether government has the power to issue a show cause notice under section 73 or 74 for demanding wrongly availed trans 1 credit without going into the merits of the case. You have claimed your trans 1 credit either under section 140 or 141 or 142 as the case may be, without drilling down into the merits of the case, whether they have the power to demand this transitional credit from you. And the second issue which we will discuss is whether they can demand interest on this wrong transitional credit as per them. Obviously, whenever we will get a show cause notice, we have to reply on the merits and all other grounds also. What we will be discussing in this case study is the technical ground, whether a show cause notice is possible or not. Section 73 and 74 is the relevant section for discussion purpose. It deals with issuance of show cause notice. In what all cases show cause notice can be issued under 73 or 74? First is where there is a tax which is not paid or short paid, then erroneous refund or input tax credit wrongly availed or utilized. So if it is on account of fraud, willful suppressions, etc., 74 will merit consideration. In all other cases, notice will be issued under section 73. So notice can be issued in cases like tax not paid, tax short pays, wrong refund, or input tax credit wrongly availed or utilized. Only in these scenarios, show cause notice can be raised. What do you mean by input tax credit? 73, 74 uses the word input tax credit. Let's go to the definition of input tax credit. Input tax credit means the credit of input tax. Again, input tax is defined. It says input tax in relation to a registered person means the CGST, SGST, IGST on any supply of goods or services or both made to him and include IGST on import or reverse charge credit, etc. So ultimately, the definition of input tax credit means only the credit which you have taken in GST regime, that is the CGST, SGST, IGST credit, either under forward charge or reverse charge or on import of goods. So the first argument is that if government is issuing a notice under 73 and 74 for demanding wrongly availed transitional credit, they don't have the power to issue a notice under 73 or 74 because 73 or 74 deals only with input tax wrongly availed and not wrong transitional credit. I repeat, it deals with only input tax wrongly availed and not wrong transitional credit. Now let's go to Rule 121. Like somebody can say, okay, 73, 74 deals with ITC only, but we have a reference of Rule 121. Let's see what is Rule 121. Rule 121 says the amount credited under sub-rule 3 of Rule 117 that deals with transitional credit may be verified and proceedings under section 73 or as the case may be 74 shall be initiated in respect of any credit wrongly availed, whether wholly or partly. So somebody can come and say 121 specifically says that the transitional credit can be verified and proceedings under section 73 and 74 may be initiated. So under Rule 121 read with Rule 73, 74, government can issue a show cause notice. Please note, very important aspects. The way Rule 121 is drafted, Rule 121 does not borrow the provision of section 73 or 74 to be applied mutatis mutandis. It simply says, what it simply says that the transitional credit may be verified and proceeding under 73 and 74 may be initiated. It does not that 73 and 74 will apply mutatis mutandis. So it only says that proceeding under 73 and 74 can be initiated, and proceeding under 73 and 74 can be initiated only in respect of ITC wrongly availed and not transitional credit. Accordingly, even after having 121, Rule 121, government does not have the power to issue a show cause notice under 73, 74 demanding wrongly availed transitional credit. So this is one of the most important points which we all should keep in mind. And whenever we are replying to all such notices, we have to keep all these grounds in the reply to the show cause notice. So Rule 121 does not borrow the provision of 73, 74. It only says that the proceeding under 73, 74 will be initiated, and what is covered under 73, 74 is only ITC wrongly availed and not transitional credit. Otherwise, also this Rule 121 itself is ultra virus. See, 121, it talks about that the proceeding has to be initiated under Rule 73 and 74. And what is the purpose of rule? This rule is ultra virus, section 164. I will take you to section 164, which empowers government to make rules for carrying out the provision of the act. Now, under section 140, there is no provision for recovery of wrongly availed transitional credit. I repeat, under section 140, there is no provision for recovery of transitional credit. So you cannot have a rule to carry out the provision of the act. In the act itself, when there is no mechanism for recovery of wrongly availed transitional credit. So Rule 221 is beyond the rule making power in the absence of any recovery provision under the statute. Accordingly, Rule 121 is ultra virus. Without prejudice to that, Rule 21 is not properly drafted to enable government to issue a notice under 73, 74, and hence transitional credit notice cannot be issued under 73, 74, and there is no other section to demand wrongly availed transitional credit. Moving on, another issue. Okay, I have availed wrongly transitional credit. I have utilized also the wrongly availed transitional credit. My question to the participants, I want participants to write. I availed a wrongly transitional credit in, say, January 2018. I had utilized it. Now I am reversing it. I have taken a suo motu decision irrespective of all this argument, since department is contending that credit is not available, transitional credit, because of some merits. I am reversing it today in 2022. Am I required to pay the interest on this wrongly availed transitional credit, which I have utilized also? Is interest payable legally under section 50? I want people to write in the chat box. According to them, is interest payable? Zulfar sir is saying yes, interest is payable. Any other view? Yogeshwar sir is saying yes, it is payable. I want people to write. So, generally the perception is yes, interest is payable if the transitional credit is wrongly availed and utilized. Mengol sir is saying no interest. So let's see what is the rule. When we go to whether interest is payable or not, it has to come out of the act. Let's see what is there in the act. Section 50 subsection 1 and section 50 subsection 3. These are the relevant provisions for us. 50 subsection 1 talks about levy of interest where a person fails to pay the tax on any part thereof. So 51 talks about failure to pay the tax. 53, that is applicable only in a scenario where ITC is wrongly availed and utilized. Even this section 50 subsection 3 has been retrospectively amended, and it has been made crystal clear that interest will be leviable only in a situation where input tax credit is wrongly availed and utilized. So we have section 50 subsection 1, we have section 50 subsection 3. What we discuss now, what is input tax credit? Input tax credit is the credit of the CGST, SGST, IGST, which I have taken in the GST regime. Transitional credit is not input tax credit. It does not satisfy the definition of ITC for the purpose of the CGST Act. So our argument is that since transitional credit is not input tax credit and the provision to levy interest is given under section 50, and section 50 only talks about a situation where there is a failure to pay output tax or where the ITC is wrongly availed and utilized. There is no other section to levy interest on wrongly availed transitional credit and which has been utilized. Accordingly, there should not be any interest implication on the wrongly availed transitional credit. I repeat, there should not be any interest implication on the wrongly availed transitional credit for the reason that there is no provision under the CGST Act to levy interest in such kind of mistake. Interest is a substantive provision. We have Supreme Court judgment in the case of Indian Carbon or JK Synthetic, etc., where they have held that if government wants to impose interest, it has to come out of the act, it has to come out of the statute, and in the statute they had imposed interest only in cases where there is a short payment of output tax or where ITC is wrongly availed and utilized, and not for the transitional credit. Accordingly, no interest is legally payable. So these are the arguments which we should keep in mind whenever we are dealing with transitional notices. Moving on to the next set of very important issue which is being faced by the industry, like even during departmental audit or during any investigation, etc. One of the most common point government official raise: if you have not made payment within 180 days, please reverse the credit. And if you have not reversed the credit, and if you have made the payment later on, please pay the interest. They keep on demanding interest from the first day of availment of credit. So this is the issue. This is one of the burning issue which is being faced by almost all the taxpayers. Let's see what is the legal remedy. Let's see what is the legal remedy for such kind of issues which we are facing. And we will also look into some of the good interpretation, which will be a food to thought for everybody. Let's see whether we can actually contest such a kind of matters or not. When we see section 16 subsection 2, it says where a recipient fails to pay to the supplier of goods or services or both, other than the supplies on which tax is payable on reverse charge, the amount towards the value of supply of goods or services along with the tax payable thereon within a period of 180 days, the amount equal to the ITC shall be added to the output tax liability along with interest in such manner as may be prescribed. For what does section 16 says is that if you fail to make the payment within 180 days of the date of invoice, the ITC will be added to your output liability. So this is the relevant section. Moving on to the relevant rule, Rule 37. Please note that Rule 37 has been amended effective 1st October 2022. So we will be discussing rule which was prior to 1st October 2022, that is for the period 1st July 17 till 30th September 2022. Thereafter, we will discuss the provision which is applicable effective 1st October 2022. So let's go to the pre-amended provision, earlier provision, which is effective till September 2022. And most of the dispute which we are facing is for the earlier provision. Department comes and say, you have not paid payment within 180 days, please reverse the credit. And if you have made payment later on, say after 270th day and have not reversed the credit, they are also demanding interest. They say Rule 37, interest should start from the date of availing the credit. My first question, and as per section 16 read with Rule 37, are we required to reverse the ITC if I have not made the payment within 180 days? I have an invoice, recorded the invoice, avail the credit, payment not made within 180 days. Am I required to reverse the credit as per section 16 read with Rule 37? I want people to write, because this is a very common issue which they are facing. Are we required to reverse the credit if payment is not made within 180 days as per the earlier Rule 37, which was effective till September 2022, read with section 16? Mayank sir is saying yes. So like general answer is yes, yes, yes. I think Yogesh sir is saying no. So most of the people are saying yes. See, now let's see if we are actually practically facing this issue and how we have to defend it, how we can defend it. So this is just food for thought, how we can defend it. Like people are saying yes, yes, yes with interest, yes without interest, etc. Let's see how we can defend it. If we don't have to reverse, like what is the argument which you have to take? Let's see section 16. What is written in section 16 is that the ITC which you have, the amount equal to the ITC shall be added to the output tax liability along with interest thereon in such manner as may be prescribed. And what is the manner prescribed? Rule 37. It says that such amount of ITC availed shall be added in form GSTR 2. So all this amount what we have to declare is in GSTR 2, and that will be added to the output tax liability of the registered person. So the way my section 16 and Rule 37 is drafted, this is based on my old concept of GSTR 1, 2, 3, wherein in GSTR 2 we had a specific format for giving all such kind of details. So the way section 16 and section 37 is worded, it is based on the entire mechanism, how you have to reverse the credit, how it will be added to the output tax liability, etc. Today, whether it is added in your output tax liability in GSTR 3B, the answer is no. The way entire section and rule is worded, it is based on your GSTR 2, wherein you had to put the details in GSTR 2, which would have added the same in your output tax liability. The argument which we want to take is that these rules and section is based on GSTR 2 format, and since GSTR 2 format is not implemented in India, it is not practically possible to implement the procedure prescribed under Rule 37. And in the absence of implementation of this procedure prescribed under Rule 37, this rule and section should be deemed to be kept in abeyance, and accordingly, I should not be held liable to reverse the credit. So that is the legal argument which is available to us to fight the case that the way section and rule is drafted, this is based on my GSTR 2 concept, and in fact it is for the first time. In fact, it is for the first time that effective October 2022 they have amended the rule. And see, if you see the amended portion on your right hand side, it simply say that ITC has to be reversed in form 3B, whereas what we are doing, so the procedure is prescribed, and this is not retrospective. Please note, this is not retrospective, and this is effective 1st October 2022. Since the entire mechanism in reverse for the reversal in 3B is given effective from October 2022 only, for the prior period, there should not be any demand in the absence of GSTR 2 format, and hence Rule 37 not applicable. So that's the possible argument which many players are taking to fight this case. So that is one argument. Second issue which we generally face is that people come and say, department officials, you have to pay interest from the date of availment of credit, irrespective of the utilization, etc. So whenever we are actually facing any interest demand, practically what we have seen is there are cases wherein people have not paid within 180 days, but eventually they have paid after, say, 270th day, after 365th day, after a certain period of time, they have actually paid. So generally it's the interest which department people are imposing. So whenever you get such kind of interest demand, one argument we have discussed that Rule 37 itself is not applicable, hence interest not possible to be levied. Apart from that, departmental official always start levying the interest from the date of availing the credit. Please note that if you have not utilized the credit, they always say, see Rule 37, it says started from the date of availing the credit. When you, and this rule is, this interest under Rule 37 is under Section 50. When we see Section 50, that only talks about a situation wherein interest can be levied, wherein ITC is wrongly availed and utilized. Both condition has to be satisfied. Section 50 is retrospectively amended to say that interest can be levied only when ITC is wrongly availed and utilized. And what this Rule 37 says, starting from the date of availing the credit. So this is ultra vires to the extent the ITC is not utilized. You cannot demand interest only merely on availment of credit if ITC is not utilized. So please note that until and unless you utilize the ITC, interest cannot be demanded under the previous Rule 37. Now, moving on, after October 2022, all these arguments which we are taking after October 2022, if we talk about the current period, this argument that the GSTR 2 is not there, Rule 37 cannot be implemented, all these arguments cannot be taken in amended Rule 37. If you have not paid payment within 180 days, you have to reverse the credit. But amended Rule 37 is silent on from which date interest will be leviable. Is it from the date of availment? See, I have availed the credit on 1st of January, in the January month. Is it from the date of January 2023, say? Or it is from the date of utilization, or it is from the date of completion of 180th day. So let me give an example. When we talk about the amended Rule 37, in ITC availed January 2023, ITC utilized March 2023, and 180 days is getting over in June 2023. At that time, when I am reversing the interest, reversing the ITC, from which date I am liable to pay the interest? Is it from the date of utilization, since I have utilized in March 2023, or it should start after the completion of 180th day? And Rule 37 is silent on this, from which date the interest will start. So in the amended Rule 37, I want people to write in the chat box, what is their view? Is it from the completion of 180th day, or is it from the date of utilization? In our example, January 2023, ITC availed. March 2023, ITC utilized. But June 2023, 180 days over. So we are having again mixed views. Somebody saying from the date of utilization, somebody saying from June, means is saying, so most of the people are more into from the date of utilization, that is March 2023. See, we see section 50 also. Section 50 simply says, as soon as you have availed the ITC and utilize it, your interest mittal will start. But when we see section 50, see any interest, so most of the people is saying utilization, right? Utilization is one of the probable answer and a safe answer. But just food for thought, which I want to discuss with all of you. Section 50 talks about when interest will be levied when ITC is wrongly availed and utilized. The word used is wrongly availed and utilized. Please tell me, in the month of March 2023, when you utilized this credit, was it a wrong utilization? In March 2023, was it a wrong utilization? At that moment of time, it was not a wrong utilization. June 2023, when 180 days got over, then your reversal is triggered. Before that, when you utilize it, it was very well within the four corner of law. It is only in June 2023 that is your reversal got triggered on account of non-payment within 180 days. According to me, in my personal view, interest should be levied only after the completion of 180 days, is in spite of the fact that your utilization has taken place in March 2023, because that time when you utilized, it was not a wrong utilization. It was not a wrong credit, wrong utilization. Accordingly, interest should be applicable only from after the end of 180 days. Furthermore, where you have not at all utilized the credit, 180 days over, no interest payable. Say you are reversing after 250th day, but you have not utilized the credit, no interest payable. So the crux is interest should be levied from the date of utilization or completion of 180 days, whichever is later. I repeat, interest should be levied from the completion of 180 days or date of utilization, whichever is later. That is a possible argument to my view. Obviously, all these things have to be tested in court of law. Again, one important point when this Rule 37 got amended was that earlier in Rule 37, it was clearly written, if you have made the partial payment to the vendor, you have to reverse only to the partial ITC only to the extent you have not made the payment. But this kind of provision is not there in Rule 37. So there was an anomaly, whether the fact that vendor has raised an invoice of 100 rupees, I have paid him 60 rupees, not 40 rupees. Whether I have to reverse the ITC to the extent of 40 rupees or entire 100 rupees. There was an anomaly in the amended Rule 37 language, which now in 48th council meeting, the government has clarified that it is only on the proportionate reversal only which you have to do, the partial amount. The last point before we proceed to the next case study. I am a supplier of capital goods. I supplied capital goods to you. The taxpayer availed the input tax credit, but when generally what happens whenever such big capital goods are supplied, the payment terms in the purchase order itself is written 50% at the time of supply of goods and remaining 50% after 365th day. So the seller has sold capital goods to the recipient. Payment terms in the purchase order is 50 rupees at the time of 50% at the time of invoicing and remaining 50% at the time of end of 365th day. Now you have availed, the recipient has availed full ITC. As soon as they received the invoice of 100 rupees, they availed full ITC of 18 rupees. They paid 50% amount to the vendor. Remaining 50% they are due to pay after 1 year. So once they have availed this 18 rupees credit after 6 months, since they have not paid 50 rupees till 180 days, are they required to reverse the credit? I want people to write. Purchase order terms say pay remaining 50% at 365th day. But departmental official comes and say, sir, 180 days over, you have not made the full payment. Please reverse ITC to the extent of 50 rupees. Is departmental official right? Mendel sir is saying no. Asit sir is saying legally as per the Contract Act, no. See, again, mixed answers. When we see section 16, it simply says where a recipient fails to pay the tax. So there has to be a failure. And when will failure occur? Failure will occur only when there is an obligation to pay. When my contract and my PO itself says that 50% has to be paid at the end of 1 year, there is no failure. Accordingly, when there is no failure, section 16 reversal should not trigger. So again, that is the possible argument which we should take. So all these arguments is something which we can always take while fighting for the past cases. But when we talk about the future, we generally always advise be conservative to avoid any unnecessary litigation. But at least for the past period, all these arguments is very much possible. Next set of issues which is being raised by almost like this notices has been issued to almost all the companies who have got their listing done. ITC on IPO expenses. Now, a company has come out with an IPO. Generally, what happens? They issue fresh shares also, which is subscribed by way of subscription. And apart from that, there is a sale of existing shares also, offloading of shares by the existing shareholder also. Now, for whenever a company gets themselves listed and they issue shares, etc., the entire IPO concept, a lot of services availed by them. Advertisement services, merchant banker services, valuation services, processing fees, brokerage services, legal services, so many services which is availed for this entire, which I generally say IPO expenses, a list of IPO expenses on which GST credit is availed by them. Now, the notice which department, and this inquiry is being initiated by DGI Gurgaon, what they are doing and what they are saying is that, sir, under section 17, transaction in securities is deemed to be an exempt service for the purpose of reversal. Again, I repeat, section 17 subsection 2 specifically says the value of exempt supply shall also include transaction in securities. They are saying that whatever expenditure you have incurred and whatever credit you have availed, you have used these services for issuance of share. Issuance of share is nothing but a transaction in security, and accordingly, credit is not available because these services are directly linked with issuance of shares. And issuance of shares is transaction in securities. So the issue which is being faced by the industry is that department is coming and saying whatever expenditure which we are incurring on IPO, be it related to merchant banking expenditure, legal fees, valuation fees, etc., all these expenditure is directly linked with issuance of share. Issuance of share is nothing but a transaction and security on which no GST is payable. Accordingly, ITC is not available. Is department right? I want people to write based on their understanding and their experience. Is department right? Mains are saying yes. Others also, like whatever view comes, I'm issuing a share. It is a transaction in security, hence credit is not available. That's the department contention. Asit sir is saying no. See, in my view, the contention of department is not correct. The purpose of this section 17 subsection 2, where it is written that the value of exempt supply shall include transaction in securities, it basically covers wherein you are engaged in purchase and sale of shares. So in case of trading in, say what happens when in many corporates, there is an idle fund and they deploy their idle fund in purchase and share of shares. So that is the transaction which is actually covered in this section 17, wherein a tax industry is engaged in purchase and sale of shares, and as per the rule, 1% of the sale turnover is treated as exempt service. But when we talk about issuance of shares is not a transaction in securities. It's a share which you are issuing, you are getting money for the purpose of business. So the concept of transaction in securities, the phrase transaction in securities is not wide enough to include fresh issue of shares. Fresh issue of shares is not a transaction in security. It's a fundraising process by the company. What is referred in transaction in securities more of purchase and sale of shares, because similar concept was there in pre-GST regime also, when there was a concept of trading in securities was deemed to be an exempt supply for the purpose of ITC reversal. Here, though the word used is trading is transaction in securities, but it should not encompass this issuance of fresh shares. Accordingly, in my view, this expenditure is a business expenditure which is directly covered under section 16 and full ITC should be available. This is not a transaction in relation to transaction in securities. Another important issue being raised by the department is on corporate guarantee. Again, DGI Ahmedabad, DGI Chandigarh, DGI Gurgaon, many anti-evasion companies have issued multiple notices and investigations have started on GST on corporate guarantee. So practically what happens is that a subsidiary company is taking a loan, but they don't have the requisite financial. So holding companies give corporate guarantee to the bank on behalf of the subsidiary company. And this corporate guarantee generally comes under contingent liability in my balance sheet. What these department people are doing is that they are saying this activity of giving of corporate guarantee by holding company to the subsidiary company is taxable and issuing notices. Friends, when we see section 7, read with schedule 1, it specifically says supply of goods or services or both between related persons or distinct persons when made in course of furtherance of business is taxable. So any supply of goods between related person is taxable. Holding companies and all my subsidiaries, joint venture, they all come under the definition of related person. So the issue is that when a corporate guarantee is given by holding company to the bank on behalf of the subsidiary company, is there is a supply by holding company to the subsidiary company, is GST payable on this? When we see supply, see ultimately it has to be a supply, and supply is a very, very wide term. Supply means to give, to perform, to undertake, to do. It's a very wide term. So when I am giving a guarantee, see, if holding company does not give guarantee to the bank on behalf of subsidiary company would not have got the loan. So there is an activity of giving of guarantee. Like bank also give bank guarantees on which there is a service element involved. Similarly, in this, there is a corporate person. There is a holding company which is giving a guarantee, and this activity of giving of guarantee is wide enough to be covered under the phrase supply of services. So prima facie, this phrase is wide enough to include such kind of activity of giving of corporate guarantee. But if we want to actually litigate, there are few judgments in income tax wherein they have said that this activity of giving of corporate guarantee is not in the nature of service at all, like Microlink. They held that corporate guarantees are in the nature of, again, these are income tax judgment, and this court held that corporate guarantees are in the nature of quasi capital and shareholder activities to provide or compensate for the lack of core strength of raising finance from the banks and cannot be construed to be in the nature of service. I repeat what the law says, what the judgment says. Corporate guarantees are in the nature of quasi capital and shareholder activities to provide or compensate for the lack of core strength of raising finance from the bank and cannot be construed to be in the nature of provision of services. So relying upon such kind of judgments, one may argue that there is no supply of services by holding company to the subsidiary company, since corporate guarantee is entirely entrepreneurial in the sense and is issued for maximization of gains and is not in the nature of services. But again, all these are income tax judgment, and to what extent they will be applying in GST is something which we have to wait and watch. In my personal view, the phrase supply of services under Schedule 1 is very wide, and this activity of giving of corporate guarantee to the subsidiary company may come under that particular phrase. However, for litigation purpose, if we have to fight, we can fight using these judgments. Moving on, please note that giving of corporate guarantee is not an actionable claim. Actionable claim is something which is called an unsecured debt. Only when a fault occurs and holding company becomes liable to pay the amount to the bank, at that time actionable claim will come into picture. Take an example of insurance. When insurance company is issuing a policy to a taxpayer, they are charging GST because that's a service element, giving of insurance services. Actionable claim come into picture when a tragedy happens and compensation becomes due to be paid. At that time, concept of actionable claim comes into picture. Similarly, in this case also, giving of corporate guarantee is not a transaction in actionable claim, and hence there would be a GST exposure. So practically, in most of the taxpayer, what we have seen is that the related party can always get the credit, input tax credit. And there is a second proviso to Rule 28, which says that if ITC is available, then any value will be deemed to be the open market value for the purpose of valuation. So in that situation, you can take the benefit of second proviso to Rule 28 and put any value for corporate guarantee. However, where full ITC is not available, then in such cases, we have to apply certain logics to arrive at the valuation. You may take a valuation report from a registered valuer. You may take BG, though practically there is the percentage in BG and percentage of CG should differ because both are different instrument, but at ground level, department is considering BG also as a relevant document for the purpose of valuation. So on all these bases, we have either through a registered valuer report or through the BG, we can justify the valuation. So again, it's a very, very important issue being raised by the department. And again, another important point which they are raising is giving of corporate guarantee a one-time activity or is it a continuous supply of service? What department is saying is that this is not a one-time activity. It is a continuous supply of service. You gave the corporate guarantee in 2017. Today also, it is running. So they are saying every year you have to pay the tax on corporate guarantee. If it is coming in your balance sheet as contingent liability, every year you have to pay the tax. To my mind, that interpretation by the department is wrong. It is a one-time activity. The day when you give the corporate guarantee, that bank, you have given 100 crore rupees loan to my subsidiary company. I am giving corporate guarantee till the time he return 100 crore rupees loan. I am there to support you. So it's a one-time activity and it is not in the nature of continuous services wherein this will be deemed to be renewed every year. So for the corporate guarantee given in service tax regime, there is a deal of judgment which says no tax payable because there is no consideration. But what department is saying, if those corporate guarantee, even if given in service tax regime, if they are continuing in GST regime, then in GST every year pay the tax, which is a wrong interpretation to my mind. So again, it's a very interesting issue being raised by the department. The next set of issues which we will discuss is ITC on various kinds of proportional activities which I am undertaking. I will take 5 examples to discuss this quickly. First, say I am giving a foreign trip to my dealers, distributors, etc. Foreign trips to them. Second is I am distributing poster, hoarding, brochure, price list, calendar, diaries, pen, all these items. Third is say buy one, get one offer or gift on achievement of certain scheme. So let's take these. We will take these examples to understand in what situation credit will be eligible, in which situation credit will not be eligible. Input tax credit in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gifts of free sample shall not be available. I repeat what the rule says. ITC in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gifts of free sample shall not be available. Please read this very carefully. This is the section 15(5)(h) which says ITC not available in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gifts or free sample. Gift is something which is given voluntarily, without any consideration, directly or indirectly, something given voluntarily. My first case study, foreign trips to your distributor. You gave various foreign trips to your distributor. Your tour operator in India raised an invoice on you, charging GST. Can you avail the ITC on the tour operator invoice which you have received and the services in respect of foreign trips which you have given to your distributor or dealers, etc.? Are you eligible to avail ITC on this tour operator invoice in respect of foreign trips which you have given free as gift to your distributor? I want people to write. Foreign trip, tour operator invoice, credit available? No, because this is given as gift to the dealer. So is that the reason no ITC, no ITC? Everybody is saying no, but why no? Under which clause? Everybody is saying no, that ITC is not available. See, section 16 says ITC is available if an expenditure is in the course of business. This is an expenditure in the course of my business, hence section 16 is applicable, ITC is available. We have to see that we are not covered under any negative list. Are we covered under section 17(5)(h)? As per which section I am barred? Section 17(5). Am I barred under section 17(5)(h)? If I am giving foreign trips as gift to the dealer. Exactly. Master sir has said goods, like somebody is saying 17.5H we are barred, but one of the comment is goods restricted and not services. Please read what is restricted under section is ITC in respect of goods lost. Say if you are gifting us a gold coin to your distributor as gift in Diwali, credit not available. But when we talk about the service, tour operator was a service. When tour operator raised an invoice on you, it was a service invoice. And if you are giving these foreign trips to the distributor as free of cost, no ITC is required to be reversed, because the restriction under section 17.5H is only on goods and not services. And in fact, if you read the restriction under other clauses, there the legislature has used ITC in respect of goods and services. Say goods, ITC in respect of goods and services for construction not available. ITC in respect of goods and services for personal consumption not available. But what they have used in 17.5H is only goods and not services. Accordingly, credit should be available. Please note, in all such cases, if you are getting a service invoice, credit is available. What is there in the law is goods. So the purpose of this section is to actually see how to read the law. You have to read each and every word, and again and again read, and always whenever you read the same line again and again, you will always come out with different thought, different interpretations. Many people are talking about sharing of PPT. I will be sharing the PPT to all the participants through Webtel. Now let's come to the next point. To ITC on diaries, pen and calendar distributed to the distributor, or brochures, price list, etc. Is credit available? I'm distributing brochure, price list, diaries, pen, calendar. Is credit available on all items or on certain items, or not available on any item? See, it's a very general point. And see, we are practicing in GST or we are in any company, etc. It's a very common point being faced. So what is the treatment which we have been giving for the last 5 years? Is credit available or not for brochure, price list, diaries, pen, calendar, which I distribute? I want people to write. Let's make it interactive. Whatever your thought process is, either say available for this, not available for this, or brochure, price list, diaries, pen, calendar. See, we have to divide all these into 2 parts. First is means of communication. Like people are saying not available, not available. So let's divide an entire brochure, price list, diaries, pen, etc. into 2 parts. First is something called means of communication. And second is something which is in the nature of gift. See, what is a gift? Gift is something which is of some economic value to the recipient. If I'm giving us, say, a pen, cross pen, expensive pen, it is an economic value to the recipient, to the distributor. He can use it for personal purposes also. But when we talk about brochure, price list, hoardings, is this a mean of communication? But is it in the nature of gift? Will he use brochure, price list, hoarding for his personal purpose? No. Your brochures, your price list, your hoardings, your advertisement material, all these things are in the means of communication, which is of no personal economic value to the distributor or the dealer. Whereas when we talk about expensive diaries, expensive pen, etc., which he can use for personal purposes only also. So credit will not be available to the extent ITC pertains to pen, diaries, etc., because these are the items which is in the nature of gift, because this can be independently used by the distributor for his personal purpose and has an independent economic value. Whereas when we talk about brochure, price list, all these are in the nature of means of communication only, which is of no use personally for the distributor and cannot be in the nature of gift. See, both things are for furtherance of business. When the brochure is for furtherance of business, diaries, pen is also furtherance of business. That's why I'm covered under section 16. The issue is, how am I out under section 17.5H by virtue of stating that this is in the nature of gift? So what can qualify as gift is only the diaries, pen, which has certain personal economic value to the recipient, which can be used independently and personally by them, and not brochure, price list, means of communication, and hoardings, etc. Let's see the next case study. I am a manufacturer of pharma product 12% is the GST rate on my output. I have come out with a target based scheme. Distributor, if you purchase this much of quantity in next 3 months, I will give you a watch free of cost. So this is the scheme which I have floated. Distributor, if you purchase this much of goods from me in the next 3 months, I will give you watch free of cost, whether ITC is available or not. See, ITC is not available when something is given in the nature of gift, free of cost. In this case, we can always contend and say that when I have floated a scheme stating that if you purchase this much of quantity for 3 months, I will give you a watch free of cost, then the consideration which he have paid to me for purchase of certain amount of goods is for both the pharma products which I have supplied to them as well as this watch. So it is not in the nature of gift, rather it is in the nature of the target based discount or in the incentive which I am giving to the recipient, the distributor or the dealer. The scheme which I have floated is distributor purchase 1000 quantity from me, get 1 watch free. He complied with the target based scheme and I am legally obliged to give him this watch. It is not given something in the nature of voluntary, that I'm giving voluntary sumuto like a Diwali gift, etc. He has completed contractually my target based scheme. I'm legally bound to give this watch to him. And effectively, the consideration of this watch is embedded in the consideration which he has paid to me for the 1000 quantity. So this is not in the nature of gift, and accordingly ITC should be available. But the real problem is, as soon as we take an argument that ITC should be available, as soon as we take this argument, the real problem will be the problem of mixed supply. Department will say that for this 1000 quantity of pharma products, say he has given you 1 lakh rupees, distributor. They will say that you have received a consideration of 1 lakh rupees, and in that 1 lakh rupees, you are supplying him 2 things. One is the pharma product 1000 quantity, and second is the watch single quantity. Accordingly, this is in the nature of mixed supply. Your pharma product 12%, your watch 18%. Accordingly, highest rate applicable on the entire quantity. So that is the risk which we will carry. So it is always advisable whenever we are making any target based incentive scheme, in that situation, whatever product which we give complimentary as on achievement of target based scheme, ensure that the rate of those products should be equal to the rate of tax on your main product or lesser than that. It should not be higher in the example that the way which I have taken. So always ensure that. Another very common issue being faced, ITC on hotel expenditure, travel expenditure, uniforms, gloves, etc. What is barred under section 15(5) is credit on food and beverages. Credit on food and beverages, outdoor catering, beauty treatment, health and services, etc. not allowed. Life insurance, health insurance not allowed. However, there is an exception that if this is mandatory under certain law, then credit on food and beverage will be available. Second restriction which is there in GST is good and services or both used for personal consumption. That is the second restriction. Now, when we talk about uniform, gloves, helmet, safety shoes, office laptops, credit is available. Department at ground level, we have seen denying it, stating that this is used for personal consumption. Please note, this is not a personal consumption for the taxpayer, for the company. When an employee is using gloves, helmet, safety shoes, etc., this is not a personal consumption for the company. It is it is rather a business expenditure for the company. Accordingly, credit should be available. In fact, there is no concept called personal consumption of the company. It is this particular clause of personal consumption applies only in case of a proprietor. So an individual proprietor has purchased certain things which you have used personally as well as for business purpose. When we talk about from a company perspective, from a partnership firm perspective, at that time, there is nothing called personal. Second important, hotel and travel expenditure. Yes, credit is available on your airline tickets, on your rail tickets, credit is available. Please note that what is barred is chartering of aircraft. DGI is issued notices on credit availed on chartering of aircraft. Huge investigation is going, and this issue is being raised by DGI Gurgaon, wherein they are contending that ITC is not available on leasing of aircraft, chartering of aircraft. So there is a dispute on chartering of aircraft, but credit is available on the normal transportation passenger services, which we avail from a scheduled airline, say Indigo, etc. But just ensure that invoice is raised on your name and credit is available, because all these expenditure in hotel as well as in airline, all these is incurred in the course of business, credit fully available. In hotel, room charges credit is available, but ITC on food, restaurant service credit is not available. So that is something which we have to keep in mind. Another very interesting issue being faced, ITC on canteen services. So there can be two scenarios where I'm not recovering any amount from the customer, from my employees. I am providing them canteen facility free of cost in my factory. So in such a situation, ITC will be available, because as per the Factory Act, if it is mandated to provide canteen facility to your employees, in that situation, credit will be available to you. However, if you are maintaining a canteen in your head office, there the credit is not available. So if canteen is in head office, credit not available, because that is not mandatory. If canteen is in factory where there is a legal obligation to maintain the canteen services, in that situation, credit on food and beverages will be available. But there is a catch. Even in factory, credit will be available only in a situation where you are not recovering the amount from the employee. Where you recover the amount from the employees, I repeat, where you recover the amount from the employees, then the dispute comes whether there is an output service, that is, there is a GST on recovery of amount from the employees, on which tax is payable at 5%. And if you pay the tax at 5%, then no ITC becomes eligible, because there is a specific restriction under the 5% scheme. So when I am maintaining a canteen, I am recovering an amount of the employee. The first issue will arise whether this recovery will result into a GST implication, though there are few advanced ruling which says that no GST will be applicable on recovery of employees, but there are other rulings also which says that GST will be applicable. The way this definition of business and definition of supply is worded in GST regime, it is very wide, and to my mind, there will be an exposure whenever you recover an amount from the employee, partial recovery. And as soon as you pay GST on that partial recovery at 5%, because of 5% restriction, your ITC will not become eligible. So whenever we are analyzing the ITC, your negative list may flow either from section 17.5 or it may flow from the rate restriction. Always keep that thing in mind. Another important issue being raised all over India on secondment of employees pursuant to this Northern Operating System judgment by the Supreme Court. So facts are very simple. Foreign entity has sent the employees on secondment basis to the Indian entity. Employee is taking salary from the foreign company, that is the foreign entity. He is the employee of the foreign entity, but has been seconded in India for a certain period of time. Indian entity is reimbursing the amount to the foreign counterpart, reimbursement of the salary and other expenditure. And pursuant to this ruling, department is issuing notices in GST regime to many companies demanding GST on the reimbursement made to the foreign entity under reverse charge mechanism, stating that this secondment of employees is nothing but in the nature of service, and hence reverse charge is applicable. So what happens? So what was the fact in Northern Operating System was that there was a taxpayer who was registered in India, and he was for providing back office and operational support services to its foreign counterpart. Their foreign counterpart sent certain employees on secondment to the Indian companies. Indian companies were deducting TDS also. They had entered into an employment agreement with the Indian counterpart also. But ultimately, I'm not drilling down much into this judgment. In very brief, what the Supreme Court ultimately said that after reading the entire contractual term, providing services to the foreign counterpart, and ultimately they held that this activity of secondment of employees to the Indian counterpart is nothing but in the nature of services, and hence credit and hence reverse charge is applicable. Now, after this judgment, what department is doing that they are issuing notices to many companies. How to deal with these notices which we are receiving for the past period, and what should be the stand for the future period? First of all, if we talk totally academically, each agreement is different. So in our case, if we are able to justify that this is my employee, he's working under my control supervision, he's my employee, I'm detecting TDS, he's bounded by them, and he has left the employment of the foreign counterpart, and he's the employee of me for the tenure of the secondment. In that situation, we may contend that reverse charge is not applicable. I repeat what I want to say. If the employee, if my agreement is worded in a manner, if my arrangement is worded in a manner wherein I'm able to prove that this person who was seconded to the Indian taxpayer has left the job in the foreign entity and is under the employment of the Indian entity, then you can establish that there is an employer and employee services. But what Supreme Court has not discussed is the concept of the dual joint employment. That is, if this employee is also the employee of the foreign entity, also the employee of the Indian entity. This concept has not been discussed effectively. What they have said is that in such a situation, there will be a service element which will be there. So to my mind, for the past period, the way the Supreme Court judgment has laid down, it will be very difficult to contend that until and unless you are able to prove that the employee, the seconded person is the employee of the Indian counterpart and not the foreign counterpart, differentiating this judgment will be a highly matter of debate, and obviously everything will depend on the terms of the contract. The issue which I want to raise in this was just a background. The issue which we want to raise is that today you receive a notice. What should be my strategy? 17, 18, 18, 19, 19, 20, 21, for 4 years, 5 years, they issued a notice. You have, say, reimbursed 50 crore rupees to the foreign counterpart. They are demanding 18% GST, 9 crore rupees, pay under RCM. One way is that, again, if you don't pay, this will be a matter of litigation, and your interest meter will keep on will be on. So the strategy which we are imposing is that since it's a matter of interpretation, this is not a section 74 matter. It is a section 73 matter. Why not raise a self-invoice today? Even for the last 5 years, let's raise a self-invoice today. Let's pay under reverse charge and take credit. I repeat, let's raise a self-invoice today, pay under reverse charge, take credit. Time limit does not apply in case of reverse charge. Under section 16(4), time limit is not applicable because it is the self-invoice which you will be raising today in 2022 and taking credit. So one is the possible solution is that pay under reverse charge under protest, take credit, and simultaneously keep on fighting the case with the department for the interest and the penalty part, etc. So this will actually help you in stopping the interest meter. Another way is looking at the agreements and the arrangement of each individual entity. If I want to really fight for the past period, I may fight. It's trying to distinguish the Supreme Court judgment. But to my mind, it will be very, very difficult to distinguish it, the Supreme Court judgment. Next issue, which generally what departmental officials this time are raising is the reimbursement. Say what there can be an issue wherein 100 crore is the salary, 50 crore I paid to the Indian employees in India, 50 crore I reimbursed to the foreign counterpart. Generally, the tax is being demanded on the 50 crore rupees foreign counterpart. But practically, if you treat it as a service, then the exposure will be on the entire 100 crore rupees and not 50 crore rupees. So this is again one of the major issue being going in the industry. Now, let's devote certain times, because already 1 hour has gone, on some of the 48 GST Council meeting updates. Some of the major aspects, I'm not covering each and every update. We'll be discussing some of the major amendments which have come in this 48 council meeting. The first, very welcome amendment. Friends, we are all aware the taxpayers are getting multiple notices on 2A, 3. Either under assessment or show cause notice or during departmental or audit, also this point is being raised. Now government has said that they will come out with a circular which will clarify the verification methodology, where there is a difference in ITC availed in Form 3B and ITC available in Form 2A. So it seems to be a welcome step. It seems that government will clarify that in which all situation ITC is not required to be reversed. In what all situation ITC is not required to be reversed. We will wait for the circular to come, but it seems to be a very welcome amendment, and it seems they will come out with various situations in which ITC is required to be reversed or not required to be reversed. But legally speaking, friends, for 17, 18, 18, 19, 19, 20, 20, 21, no ITC is required to be reversed. It is only from 1st January 2022 that the Act 16, Section 16 has been amended, wherein this condition of 2A, 2B has been imposed. Prior to that, there was a complete lacuna in the law, the way law was drafted for period 17-18 to 2020. 17, 18, 18, 19, 19, 20, 20, 21. Very, very good case to argue that no reversal is required on account of 2A, 3B mismatch. The multiple arguments available that it is an impossible activity to match. I cannot be penalized for the fault of the supplier. We have to rely upon the VAT judgments. My entire section 42, 43, the way it was drafted, it is not properly drafted. The mismatch provisions, the way it was written in the law, it was entirely based on GST 1 to 3, which is not at all applicable and cannot be implemented. So there are multiple arguments. So let's hope what the circular comes and what they all clarify for 17 and 18, 18, 19. Again, one important point they will be clarifying is the applicability of invoicing on certain entities. So what are the entities? They will be clarifying on what it will be applicable or not applicable. There are certain disputes going on. They will come out with the clarification. We are waiting for the clarification. One very, very big relief and major amendment. What happens, say, mostly in real estate industry, builders, developers sell flats to the buyer. Buyer pay, they raise demand note, charge GST, buyer pay them, tax is deposited by the developer in the government kitty. After 2 years, 3 years, 4 years, the flat is cancelled. Since flat is cancelled, customer wants its money back, but GST is already deposited in the government's kitty, and the timeline for issuance of refund, which is 2 years, or for credit note, everything is lapsed. And this actually becomes a cost to the buyer. Now government has come out with a very, very big relief for the real estate industry. And they are saying that they will come out with a mechanism wherein such unregistered buyer will be in a position to claim the refund on account of cancellation of this construction of flats, etc. So it's a welcome change and a big relief to the buyer, where tax was paid by them to the builder at the time of purchase of flat, which later on got cancelled. The builder was unable to refund the amount to the buyer and issue credit note where the time limit was over. Now at least buyer can go and take refund. What will be the mechanism of this refund? That will be known in due course of time. Again, an important amendment is this insertion of Rule 88C read with Rule 59. Now, see, let's see what is the rule, and then we will see the background of the rules. Purpose of this rule is that if there is a difference between GST 1 and 3B, government will intimate the taxpayer either to reply or to pay the differential amount. And now simultaneously, they are also introducing Rule 59, wherein they are saying that they will restrict the filing of GST 1 for a subsequent period if the taxpayer has not replied for the above notice or not paid tax for the difference in GST 1 and 3B. See, why this rule is coming is practically what is happening today is that I raise a mode to curb fake invoice cases. GST 1, I filed with a turnover of 100 crore rupees. The same will get auto-populated in your GST 2B. 3B also I filed, but today I'm filing GST 3B with only 1 lakh rupees tax liability. System will allow me to file GST 3B with 1 lakh rupees tax liability. So GST 1 filed 100 crore rupees tax liability, GST 1 lakh rupees tax liability. What will be shown in your system? That GST 1 filed. It is coming in your 2B. GST 3B status, yes, filed. Now what will happen is that government will issue a notice to me that difference in my 1 and 3B is so and so much. Either I should explain the difference or pay the differential tax liability. If I'm not able to pay the differential tax liability, they will not allow me to file the next month GST 1. So it's a welcome relief to curb the loophole in GST 1 and 3B, but it should not harm the genuine taxpayers. And that is for the departmental official at the jurisdiction level to ensure that this rule, the purpose of which, as per the policy team, is to ensure and curb these fake invoices cases, should not be used by the jurisdictional official to harm the taxpayers. So that synergy has to be maintained. Again, a very important relief which they have proposed is that under Schedule 3, they had already treated certain transactions neither as supply of goods nor supply of services effective 1st February 2019. Supply of goods from one country to another country, or high sea sale, merchant trading transaction, etc. the issue which taxpayer was facing was that lot of taxpayer got show cause notice for the period prior to 1st February 2019. Prior to 1st February 2019, they got multiple notices. Now the government has clarified that this recommendation will take effect from 1st July 2017. So any merchant trading, any high sea sale transaction, etc., undertaken effective 1st July 2017, no tax payable. Again, a very, very important amendment. The practical problem which the industry was facing. Let me give you a situation. I'm a courier company. There is a taxpayer in India, and I'm a courier company in India. I am providing or a transport company in India. I'm providing transportation services to the taxpayer. My role is to pick the goods from India and deliver it outside India. I repeat, my role is to pick the goods from India and deliver outside India. So I'm providing services in respect of export of goods by the taxpayer. I'm doing this transportation outside India, from India to outside India. Since both the parties are in India, for place of supply, I have to refer to section 12, subsection 8. And there the law is written that as per the proviso, if goods are moving outside India, the place of supply for transportation services shall be the place outside India, that is other territory. So practically what was happening was that when I was raising my transportation or courier bill to the taxpayer in India, my place of supply was always outside India, other territory. Even though I was charging IGST to the recipient, but since place of supply was other territory, as per the place of supply provision, the recipient was not in a position to avail the credit as per Form GSTR 2B, and even in 8A, this was never shown. Though legally there is no restriction in the law that place of supply has to be the recipient state, but in the portal there is a restriction. So practically taxpayer was not in a position to claim the credit. And now what they have done is that they have amended this rule, this proviso which is there in section 12.8. They will omit this proviso that destination of goods shall be the place of supply in case goods exported outside India. In such a situation, my place of supply will be the location of the recipient and credit will flow. Accordingly, it's a big relief to the taxpayer who are engaged in export of goods. Another important point which they have clarified is that, see, from July 2022, if a registered person have taken residential dwelling on rent, he has to pay under reverse charge. The problem which was being faced by was the individual taxpayers. I am an individual taxpayer. I have registered myself as a chartered accountant. I am also having a GST number. So I'm a registered person under GST. But I have taken a residential property under rent for my personal purposes, in my personal capacity for my living purpose, and not in my professional capacity. They have clarified that if residential property is rented out to a registered person in his personal capacity and not for business purpose, no reverse charge will be applicable. It's a very welcome relief, and that was always the intent of legislature also. There will be, again, another amendment is Rule 37A. Government will be inserting a rule. See, today the law says you will get the credit if the invoice come in 2B. That is only one part. Another part is that supplier should pay the tax to the government. Invoice getting auto-populated in GSTR 2B does not mean that the supplier has paid tax to the government. So they will be coming under Rule 37A. They will prescribe a mechanism that in spite of the fact that the invoice is coming in your 2B, but if supplier has not paid tax to the government, in that situation, you have to reverse the credit. And how you have to re-avail if supplier pays tax subsequently. They will come out with the exact process. And this Rule 37A will ensure that supplier has actually paid tax to the government kitty. That is, the tax has been actually paid to the government kitty, irrespective of the fact that invoice is getting auto-populated in your GSTR 2B. Another facility which they will provide is to withdraw the appeal. Many times you file appeal online, you want to withdraw at a later stage due to various reasons. That facility will be introduced. Again, welcome step from the GST Council. It would save time and litigation cost. Another issue while actually filing appeal which we face is that we have to submit the certified copy of the order. Whom it should be certified by whom? Officer or the taxpayer? No clarity. The government will come out with the circular clarifying this aspect also. Government had already in principally approved that in case of e-commerce operator, in case of unregistered supplier and composition taxpayers, they can undertake interstate supply through e-commerce operator. But it is yet to be implemented in system, and it is recommended to implement the same from 1st October 2023. Next is voluntary cancellation of registration for TDS and TCS. A facility will be introduced, allowing them to cancel suo motu. Another important amendment, time limit for filing returns, your output returns, your annual return, etc. There are people I've seen like for 17-18 till now not filed annual return. There are various taxpayer. Now they will be imposing a maximum time limit. They have recommended that maximum 3-year period from the due date of filing of the above mentioned returns shall be allowed to be filed, and thereafter you will not be in a position to file the return late also after furnishing the late fees. In section 132, they have increased the threshold for initiation of criminal proceeding from 1 crore to 2 crores. Insolvency, they will be coming out like practically what happens. There is an amount demand of 100 crore rupees, but recovery is always less. So they will come out how to deal the situation in case of IBC clients, and accordingly amendment will be made in Rule 161 and Form DRC 25. Apart from that, there are various rate changes which have been imposed. The PPT will be shared, and all these rate changes are self-explanatory. With this, we end our presentation for today. Thank you, everyone. And now we can take up question and answer, if any left. Vivek sir is saying that diaries and calendars may be used to communicate about company product, etc. as advertisement. See, your point is well taken. Whenever we give diaries and product, there are few pages which contains company's product, etc. But the only real issue is that, like, if I'm giving very expensive diaries, etc., with charging cable, code, etc., and though there are few pages talking about company's product, etc., but these diaries can be used personally by the distributor for his personal purpose also. And when we see section 15(5)(h), it says that ITC not available on gifts. So gift is something which is given voluntary. So this can be treated as in the nature of gift. But your point is well taken that we may argue otherwise also, that this is more as a means, as a communication product, but it will all depend upon the way my diary is structured. But prima facie, it will invite a huge amount of litigation. RCM is applicable on which amount? Complete salary payable. Okay, this was in the context of secondment of employees. What we have discussed is that employees got seconded in India. 40 rupees I'm reimbursing outside India, and 60 rupees I'm paying to the employee directly in India. In reality, if you actually consider it as a service, then the tax exposure will be on the entire 100 rupees and not merely 40 rupees. But as of now, what department is issuing notices on 40 rupees. Another issue is that whether ITC on residential property. Now, since on residential property, if you take a residential property on rent, the taxpayer has to pay under reverse charge. The issue is if he's paying under reverse charge, where credit is available, if they are using this property for the employees. See, legally speaking, what is barred under GST law is that credit is not available for services used for personal consumption. As we discussed, when a company is taking a property on rent and giving it to the employee for residential purpose, it is not a personal consumption of the company. See, the wording under section 17(5) is not that goods and services should not be used for personal consumption of employees. In service tax, the wording was the same. When we see the Senved credit, the wording was ITC not available, Senved credit not available if goods and services used for personal consumption of employees. Here, the word uses only personal consumption, and it has to be read qua the taxpayer. Accordingly, to my mind, good case to argue that this is not a personal consumption of the taxpayer. It is an expenditure in the course of business, hence credit available. Can free trip to business dealer fall under the nature of ineligible credit due to personal consumption? My answer is no. You should get the credit on the free trips service not covered under section 17(5)(h), and even it is not a personal consumption. It is a business expenditure to the company. think we have, let me see other questions. I think one more question is there, though I'm not able to understand it properly, whether GST implication is there if foreign company reimburses some amount like car allowance, rent-free accommodation. So what I understand is that I'm getting certain reimbursement from the foreign company. So it will depend upon like why I'm getting this foreign reimbursement from the foreign companies, etc. So rent-free accommodation, etc. You can always say that this is so again, like I have to actually drill down into the arrangement before answering this. Again, it's a very interesting issue being thrown in, like in the target-based scheme. We always say, we will give watch free of cost. So then we will come under the ambit of mixed supply if we want to take the ITC. The issue is that instead of giving gift, if item is charged at nominal rate, can we come out of mixed supply? So if you actually come out with a scheme that if you achieve this target-based scheme, then I will give you this watch with 85% discount, 80% discount. In that situation, you will come out of mixed supply, but it should not happen simply saying that I will give you this watch at 1 rupee or 2 rupees. You may give it at some basic reasonable value, but a huge discount. If you come out with a scheme wherein you are giving such products at a huge discount, then mixed supply should not come. If any queries is left, I can take them personally also. I will be sharing the PPT wherein my number will be there. So we can take up any queries which is left. Now with this, I will be ending my session. Over to you, the Webtel team. Yeah, you're mute.
Thank you all for taking the time to be here. I would especially like to thank our speaker, Mr. Tushar Agarwal, for such an insightful session. If you have joined late or missed any important information, you can watch the repeat of the session on our YouTube channel and even check out our previously conducted webinars. Moreover, to check out the highlights of the 48 GST Council Meet, refer to the blog link that has been dropped down in the chat box. For any doubts and queries, please scan this QR to give them clarified and drop us a mail on the email address given on the screen. Thank you so much.
Thank you, everyone. Thank you, everyone, for making the session interactive.